if there is one concept that I would add to your trading, no matter how you trade, whether it's ICT, SMC, Wyckoff, breaking, retest, whole numbers, key levels, etc., it would be this, and that is candle confirmation. And candle confirmation pretty much is very simple to understand. So a lot of people, right, they'd have their points of interest, and it would be something like this, right? So let's just say in a bullish market, you're gonna be looking to buy from this kind of area, right? A lot of people would probably go ahead and set maybe a limit order off there. Maybe they'd wait for a sweep and then whatever, right? But either way, all candle confirmation is that you're waiting for price to come into your point of interest. And obviously in this move here, this downward move, you're seeing what? You're seeing bearish candles, okay? So let's just imagine this is a bearish candle. All you're going to wait for from this point of interest, and this is via manual execution, obviously, right? Or maybe even buy and sell stops, but it's very risky using stop orders when obviously using candle confirmation, because there's a chance of price just wicking it and closing back below the previous candle. And it's all about candle closures. So let's say you've got this bearish candle leading into your point of interest where you're looking to buy from. On the bullish candle, that let's say because this is the bearish candle, this is where it closes, and obviously therefore the bullish candle will open here. All you're looking to do is wait for price to close above the previous open of the bearish candle in this case. And if we were to flip that the other way around, it'd exactly be the same logic, logic just the other way around. So bearish candle that opens obviously where the previous candle closed. But all you wanted to do is wait for a candle body closure that closes below the previous, in this case, bullish candle open. Okay, that's all you're doing. And then what you'll go ahead and do is set your execution order, obviously adjust TP, etc., and SL accordingly. But that's all you're doing. Literally simple as that. Okay, and the reason why this is so beneficial is because sometimes you'll probably notice that price will come into your point of interest, maybe have a short-term reaction, maybe not, but either way it'll just violate it a lot of the time, or maybe it'll just come down straight away, violate it. So throwing in this little concept, aka candle confirmation, simply just reduces the chances of price just blowing straight through your zone. So as you can imagine, it helps with mainly two things, and this is something I added around 3 years ago now. But it reduces your losses pretty much, taking unnecessary losses, and it increases your win rate essentially, right? So for example, I would try and find an example of, I guess you could say, one working, right? But in this case, this is a brilliant trade in GJ this morning that a couple of the students took. But as you can see here, right, what the price did, we shifted downside, we pull back, right? Whatever, pull back, and then we engulf. All I'm looking for in this case is we got these bullish candles. Okay, the last bullish candle is here. Okay, and as you can see, you're waiting for the candle to ideally close below the previous, in this case, bullish open of that candle. Okay, and obviously when price closes below that bullish open, the previous candle, you will then click execute. And whilst you're already doing all this, waiting for price to tap into your point of interest, whatever, usually maybe you set a limit order off there. In this case, this would have perfectly worked out. But again, a lot of the time, if you've got a POI, let's say, for whatever reason, I don't know, here, and you're looking to buy from this POI here, price just violates the zone instantly. Okay, that's just a bit of a, crappier example, I guess, but the logic applies. So the only thing is with this, you're going to want predefined stop loss placement and TP placement. A rule of thumb is obviously when you're selling within a bearish range, so this would be the bearish range low and the bearish range high. If you don't understand why this is a bearish range high and low, etc., I do have a free course that you can check out below that will give you access to pretty much the foundation to the system. That will show you how we map up structure. So no matter where you are from the world, go ahead and check that out, as it's a completely free course. But yeah, so all you want to do is obviously this is the range high and low, etc. So you'd want your stop loss obviously ideally above the range high. Sometimes you can get away with tighter stops, for example, above the high that was created during the engulfing, obviously forming. That's completely fine, but it's always better to put it above your invalidation point. And by invalidation point, I just mean simply if price was to come up above here, then that would be pretty much the market potentially flipping bullish, right? So we wouldn't really look to have it here. Price can, come up here, have a wick, and then move back bearish again. Okay. So I'll try and find some more examples. So an example of this would be, let's just say we're looking to long from here. So this would be based on this M15 bearish range low and M15 bearish range high. And as you can see, we break to the downside, we then break to the upside, we then form a new high and new low. We then pull back into this breaker, followed by an engulfing. That there wouldn't be a bad entry. And like I said with stop loss placement, at the time of entering this, they were still inside of this bullish range. So what would be better is for price to either go below the breaker, but obviously the higher probability stops would be below the range low. Now this is a pretty big range, aka that you'll have pretty big stops here in this case, but it's still, you know, it's fine to do so, right? Then anyways, as you can see here, we break to the upside, we got a new high, new low, we kind of break to the downside, but obviously, you know, when price first shifts to the downside or upside of starting a new potential trend, it's unconfirmed. So as you can see, we quickly resume back to being bullish. Therefore, we have this new range high, new range low. What does price do? We then have a new point of interest that we can go ahead and mark up, okay? What does price do? We pull back into it, we feel the imbalance, tap into our point of interest. We then provide an engulfing. Again, stop loss placement here or here, obviously better to put below here for safer and obvious reasons. But in this case, because it's kind of a bigger, you know, move from here to here and all the imbalance has been filled, there's no harm in having a stop loss here. Okay, so again, engulfing. Whereas, for example, if you maybe had a break here and you had a break here and you had this new range high and low, maybe you'd have your point of interest here. Maybe originally you'd go ahead and put your long position order here, you know, buy limit, stop loss right below the zone. This is very obvious stops for a lot of people, you know, below the zone, whatever, right? And as you can see, you would have been taken out before the move has started. But if you were just waiting for that kind of confirmation, that would have invalidated this setup and you would no longer be looking to long until price then it breaks bullish to align potentially with the obviously the bias that you have. Okay, so that's just an example of I guess I threw in a bit of a lesson there for stop loss placement, but it was mostly just regarding counter confirmation. Okay, because like I said, sometimes when you have a point of interest marked up, you'll be looking to potentially short from this area here, but price will just violate through the zone. So rather than getting stopped out and taking unnecessary losses because of the price, you know, having heavy momentum, etc., pretty one-sided market, you're then going to just simply wait for price to engulf to the downside, and engulfing is pretty much just where the candle, for example, bearish candle, closes below, in this case, the bullish previous candle open. So if we had bullish candle, bullish candle, bullish candle, bullish candle, and you're going to get a bearish candle, we need to see price close with the bearish candle to obviously close below the bullish candle open, okay? And you know, this is a good example of, for example, does it need to be one candle? So for example, you get bullish, 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 then a bearish. Does it need to be one candle? Not always. For example, this one here, as you can see, it doesn't need to just be one candle. This wouldn't be a bad trade to take either, to be honest, if you understand wicks, etc. You know, in terms of wick rejecting and stuff like that. So this wouldn't be a bad position to take anyways. This can still count as a form of candle confirmation, and I'm just simply on about this bearish candle there, even though it's not an engulfing candle below the previous bullish open, which obviously it's higher probability for price to close below here, because when you think of like this is still technically considered a shift on the lower time frame, okay? And it doesn't necessarily need to be below the low, although if you want to experiment, that's up to you. But the opening to the, you know, the closure, that's more important in my opinion, okay? Because sometimes you'll see price like this, you'll just see a big wick and price close back within the range and we continue bullish. So that's why I prefer the candle body closures below the opening there, okay? Like I said though, a situation like this where it has a big wick and, you know, pretty low, like there's no like lower wick essentially, like there's obviously a lower wick here, but sometimes you'll see like there's literally no lower wick and, you know, it's just like this one-sided. So a big wick rejection followed by engulfing, you know, that's a nice entry to get in. That's a clear sign that price is potentially reacting from your point of interest, and that's what we're looking for. We're looking for the reaction from our point of interest. So rather than entering sell limits, etc., with tight stops and, you know, risking getting stopped out here and there, just literally add candle confirmation into the mix. It doesn't matter how you trade. It doesn't matter if you trade my way. It doesn't matter if you trade SMC. It doesn't matter if you trade ICT. And yes, I don't trade ICT. I don't trade SMC, although it may be similar. It's the logic to the system really is different. Very, very different. Okay. our approach is very simple, much more mechanical and rule based. A lot of it, after after some time working with the system and gathering data, you start to become a discretionary trader. So like I said, links can be found below. I've got the free course there. I've also got the new academy that's just launched as well. You can use code founder. Hopefully by the time I'm watching this video, it's still available to get 20% off. With that being said though, guys, have a good one. Take care.